Hi folks, welcome to this video on making journal entries on a company's books and making sure that within that entry you record some goodwill. Now in this particular problem, the question first asked you to record the journal entry for the purchase of Saria by the company called Zoe at the date of purchase. So what you had to realize is that you first had to record any goodwill that Zoe would have recorded at the purchase date because they purchased Saria. So in order to calculate goodwill that Zoe would record, because again Zoe is the buyer, so I might just want to make sure that you remember Zoe is the buyer, so they're the ones that are going to record the goodwill. Don't forget what goodwill is. It's the difference between the fair value of what consideration you transferred or what you gave up. In this case, you would have noticed that Zoe gave up $415,000 in cash, and they also agreed to pay $50,000 at a later date in terms of a note. So they paid out $415,000, and they also agreed that they would pay a note at a later date. So they transferred their promise to pay in terms of the note, $50,000, and some cash. So the total fair value of consideration that Zoe transferred to Saria is in fact $465,000. But what did Zoe get from Saria? Don't forget, we record all of these elements that they got, their assets less the liabilities. So that's the fair value of net identifiable assets. We record them at their fair value because Zoe is buying fair value from Saria. So we know that cash is $75,000. We're picking up accounts receivable at net. We're picking up inventory at its fair value. And again, the receivables, it was thought at the time that the receivables at net, meaning the allowance and the gross value of the receivables, so that's $114,000 for the gross value and the allowance at $12,000. It's thought by Zoe that what Saria had was a reasonable amount, so they think that's fair value. And you would pick that value up at net. The inventory is at fair value, which Zoe agrees is $125,000. Land, building, and equipment, Zoe agreed that the carrying value of these three items, which is the cost less accumulated depreciation, is in fact an accurate estimate of its fair value. So because of that, they're picking it all up at fair value. And again, notice that the account payable, don't forget, you're picking up fair value of net identifiable assets. So fair value of net identifiable assets. So a net asset is assets less liabilities. And you believe that Saria's accounts payable is at $300,000, and that's reasonable in terms of fair value. So now you've got $465,000 that you transferred as consideration, and you also believe that what you got was $227,000 worth of net assets, net identifiable assets. So therefore, the difference between the fair value you transferred, which is $465,000, so that's the amount you're paying, and what the value you got at fair value, you'll notice that the amount you paid is greater than what you got, so you must have paid extra because you saw some additional value there in terms of goodwill. Now notice here that we do not have the trademark here. That's because Zoe felt that the trademark was worthless. Even though Saria has it booked on its accounts at a particular value, that's their carrying value, it just so happens that Zoe doesn't feel it has any value. And because of that, Zoe wouldn't pick it up because it's got a zero value. All right, so now if you are making the journal entry, this is where it gets a little bit different now. Don't forget, you would pick up cash if you're Zoe on your books at $75,000, right? But notice you wouldn't pick up the receivables at net because you'll have to go after that $114,000. So in other words, you're calculating, for the purposes of calculating goodwill, you're saying, well, the carrying value and the fair value are the same, but the fair value is made up of two pieces, right? It's made up of the carrying value, or the gross amount of the receivable, which is $114 less the allowance. And if you think those amounts are right, don't forget, you've got to set the full $114,000 up, because now the receivables are yours. You got to make sure you record what you're going after the customers for, right? The inventory, the land, the building, and the equipment all recorded at their fair value. If you're Zoe, you're also picking up the goodwill that you calculated. You're also going to add to your existing allowance for doubtful accounts balance, $12,000. That's the allowance you picked up from Saria. You've now got an extra $300,000 in fair value for accounts payable. And notice, this is where the note goes. This note is the $50,000 that's not cash in this $465 because you agreed that you would pay later, right? You would pay them $50,000 later, and Saria said, that's cool, that's fine. And again, you gave up cash of $415. So these two amounts here are this $465, right? Now we made a note here to say likely, because you'll notice you've got a debit and a credit to cash. Likely the only amount of cash that would exchange hands or would be ultimately credited is $340,000. But we wanted to show you how you would use some of these balances to help you set up your entry. Right? Now, the other learning point here, and we didn't see it in previous questions, it's just that the building and the equipment would be recorded at July 1st at their cost to Zoe. So in other words, cost is actually, in this case, the fair value, because we're saying that the building and the equipment, we believe that the carrying value is equal to the fair value. So we're saying now that we would record it at cost to us, or the value that we paid. And notice that we haven't picked up any accumulated depreciation or accumulated amortization, for that fact, on the trademark, because we think the trademark is zero. But the point here is that because you're picking up depreciable assets like building and equipment at their fair value, which in this case just so happens to be the same as the carrying value, these are the values that you as Zoe are now going to base your depreciation on for those assets for whatever you believe is the remaining useful life. So in other words, you would not pick up or recognize any accumulated depreciation that's been booked by Saria put it on your books. Why? Because you didn't calculate that accumulated depreciation. You're not picking up carrying value, you're picking up fair value. So if you've assumed that the fair value of the building and the equipment in this case happens to be the same as the fair value, then you're going to take that fair value and you're going to amortize it or depreciate it over its remaining useful life. But you don't pick up the accumulated depreciation accounts that Saria had, because you didn't depreciate that. You pick up everything that you calculate. You're calculating based on the date that you became related, which is July the 1st, right? And you picked up fair value. And the fair value here, again, just happens to be the same as the carrying value. But if it wasn't the same, then you'd only be picking up what you see to be the fair value. All right? So you don't pick up any of the previous accumulated depreciation that Saria booked. You don't pick up any of that. Okay? Now, in Part C, they ask you to do a journal entry assuming a purchase price of $204,000, all right, and no note payable. But before we go on to Part C, I want to add a little something here. We've seen what the journal entry would look like on Zoe's books, what they would pick up. But what would the journal entry look like on the seller's books, Saria? So let's go there. What would it be on Saria's books? Well, don't forget, you have to figure out, is Saria, they're selling these net assets and they're getting $415,000 in cash as well as a note. So are they going to record a gain or a loss in the sale of these assets to Zoe? We have to remove all of the assets at what we've got them booked at, which is cost, and we have to take out the related accumulated depreciation. All right, so this is where the accumulated depreciation figures in when the seller is recording the entry, because it's the seller that's booked all this accumulated depreciation. And again, we have to remove the trademark and its accumulated amortization. Now you might say, well, Zoe thought the trademark was worth zero. That's correct. So Zoe said, I'm not picking up something that I think is valued at zilch, so I'm not picking it up in my entry. But again, you're selling it and you had a value for that trademark. So you need to make sure that you get rid of the trademark at cost and any of its accumulated amortization. So now let's look at what the entry would be. In your case, if you're Saria, you're getting cash of $415, but you're also picking up the note receivable. So notice where Zoe recorded a note payable because they're going to owe Saria money. Saria sets it up as a receivable. So here's the full $465,000 that they received as consideration. Right? Now don't forget, we're doing Zoe's or Saria's books, so Saria is going to get rid of their allowance account and their receivables at their gross amount. They're going to get rid of any accumulated amortization on the trademark, the building, and the equipment. So again, they're removing these accounts from their books because they're not going to have these assets anymore. And again, remember that the trademark has a value to Saria. It just didn't have a value to Zoe. But because Saria says we're getting rid of it, we're selling it, regardless of what Zoe thinks the value is, they have to remove it from their books. And that makes you have to make sure that anything that's accumulated in terms of amortization as well as accumulated depreciation on the building and equipment are also removed. You're going to get rid of the payable, right? Because that's now being transferred to Zoe. You're going to get rid of your cash. We also talked before about the receivable at its gross amount because those accounts, what they owe you, now that's all going over to Zoe, right? The inventory is going to be gotten rid of at its carrying value as well as the land. Now, the trademark, building, and equipment, you have to think about this because don't forget, we gave you the value of the trademark, equipment, and the building on Saria's books at carrying value. But don't forget, carrying value is made up of two amounts, cost and accumulated depreciation. Right? So we got to get rid of cost and the accumulated depreciation on each of the building and the equipment, and we also have to remove the trade market cost and its accumulated amortization, right? Because, and again, don't forget, Saria is still carrying these three assets, the identifiable ones like building and equipment, as well as the intangible identifiable, which is the trademark, at their carrying value, which is cost less the accumulated depreciation and amortization for the trademark. So in order for us to get rid of the trademark, the building, and the equipment at cost, we have to calculate that. They didn't give it to you. So this is a little bit of a trick. You knew that the carrying value was $49,000 for the trademark, and you know the accumulated amortization was $47,000. So you can think of it this way. You know that cost less accumulated amortization, you know that was equal to $49,000, right? Well, you're having to calculate the cost less the accumulated amortization, which you knew was $47,000. So you know that's equal to $49,000, which is the carrying value you're given. So the cost must be equal to what? $49,000 plus this $47,000, right? So again, that would be equal to $49,000. So plus $47,000. Now, aren't you glad you took Math 101, eh? And now you got $96,000 here. So again, that would be the value at which your trademark is sitting at cost, and you're going to get rid of it at cost. You're going to do this exact same thing for the equipment. You're going to take the cost less accumulated depreciation, and that's going to give you the value of the carrying value of the equipment, right? So we're working here on the equipment, and we know that's going to be what? We know the carrying value is $90,000. 90,000 here. This is for the equipment. All right, so what do we know? We know the cost less the accumulated depreciation on this equipment, and we know the accumulated depreciation, they gave it to you in the question, is $23,000, right? So we're going to deduct $23,000 here, and that's going to give us our carrying value, and that means that your cost is going to be $90,000 plus $23,000, and that's going to be $113,000, right? So again, you can pick that up. That's your cost that you're going to remove. Similarly for the building, right? So if you did the building, it's the same thing. and that's going to be equal to what? Well, what your carrying value was, and that was given to you in the question. So now to solve for cost, you know that the building is sitting at its carrying value of $75,000, and you know that the accumulated depreciation on the building, they gave this to you in the question. They said it was on the building is $14,000, right? And that's going to give you $75,000. So again, you can solve for cost, and that will give you what? That will give you $89,000, right? So this is how we're coming up with these cost values, okay? And again, this is on the building. So I'm just using short forms here, not a problem. But again, that's your building at cost. So remember, when you're removing an asset, a fixed asset that's depreciable, you have to get rid of the cost and the accumulated depreciation on it separately. So we've gotten rid of the accumulated depreciation of the building and the building at cost. And again, cost we had to calculate. And again, you can plug to see, is there a gain or a loss on the sale? So we've plugged it here, but you can also calculate it. So how could you calculate it? Well, you could compare the net assets that you sold, and where do we get this? We can get this right from Suria's balance sheet just before they sold the net assets to Zoe, and it's in the equity section. So if you check their equity section, you can see that Suria had capital of $239,000, right? They had shareholders' equity of $239,000, and we know the difference between what they had and what they got. They got $465,000. They gave up total equity of $239,000. So they gave up less than what they got, so they got a good deal. So that's a gain of the difference. So you can plug it or you can calculate it. All right, and now we have the gain. Now, let's say we want to see what Suria's balance sheet looks like the day after the sale. So assume that we're working here it should probably be July 1st, 2000, or probably July 2nd, I think, in this case, because I think this sale happened on the 1st, if I'm not mistaken, but it's one day after the sale. You would have what? They would have cash of $415,000. We saw that. That's what they got. Right? They got cash of $415,000, right? And they've also got a note receivable of $50,000, right? And they also have capital of $465,000. Now, how did we get that? Well, their opening capital balance was $239,000, and don't forget the gain here, this gain that we booked here, this guy here is going to get closed to retained earnings, right? So you have to remember that at their year end, or once the sale was finished, they would have closed that gain to their retained earnings and updated it. So you are going to have a balance sheet that's in balance. Now, what I thought I'd do here, I just had a thought. Sometimes students get a little confused with these guys here. This came up in the class, and I thought maybe I could address it here. Sometimes students think that, well, 415, Suria got 415, but they got 415, but they gave up $75,000. Shouldn't it be that they only have cash left of $340,000? No, it isn't. Because don't forget, they started with $75,000. They got $415,000, and then they got rid of that $75,000 in this transaction, right? So this transaction here, this $415 and this $75 is here, right? The $340. But don't forget, they started with $75. So to this opening balance, they got an extra $415, and then they gave up $75. So at net, this is $415. Right? Sometimes that escapes students because they're looking at the entry and they're saying, well, at net it's $340. You're right. But don't forget, they started with $75. Right? So it turns out that it is $415. So hopefully this clarifies some things that we talked about in class, gives you more than the required, because you were not asked in this question, to be clear, you were not asked to show what the entry would look like on Suria's books. You were not asked to calculate any gain or loss to Suria. You were not asked to put together a balance sheet or a statement of financial position just after the sale for Suria, the seller. But I just thought it was a good thing, since we had covered it in class, that we should do it. Okay, now in part C, let's assume now in part C, this is the actual question, that you had a purchase price as Zoe of $204,000. Because that's less than the fair value of the net assets acquired, you're going to have negative goodwill of $23,000. Now, any negative goodwill is considered a gain in income under the current standards. So this goes directly into income. So how did we know that we had negative goodwill? Well, what I would do is I'm going to compare what I paid. So again, this is part C, which is totally independent from what they said in the original question. It didn't cost $415,000 for Zoe to buy the company plus a $50,000 note. They're changing the deal on you. They're saying it was $204. So again, you only paid as Zoe $204, but what did you get in value? You got $227. Right? You got $227. We calculated that right up here. Right here. So when Zoe recorded any goodwill that it might have got, right, it's looking at what's the fair value of the net identifiable assets that I got. Well, that was $227. So now if you compare what you paid to the value you paid less. You got a bargain purchase, right? So again, remember, they refer to this in the textbook as a bargain purchase. So you got a bargain purchase because you paid less than what you got. So this is a $23,000 gain. So negative goodwill is recognized as a gain on sale now in the buyer's books. So again, Zoe is the buyer. Okay, so because there's negative goodwill, it doesn't go in as a credit to goodwill. It goes in as a gain on sale. So we just calculated the gain as the difference between what we paid and what we received. All right, so now this concludes our review of this particular question to calculate goodwill. Record the entries on the buyer's books, and that little added extra we did, which looked at recording the entry on the seller's books and also looking at the seller's statements the day after the sale took place. So I hope you found this recording useful.